If you're new to mortgages or already got one, you may think you're doing everything right, but common mistakes can cost you tens of thousands over the long term. In this video, I'll show you the mistakes that people make, how to avoid them, and what smarter strategies look like. Mistake number one, choosing the wrong term length. Many people choose the shortest term they possibly can to save interest. This leaves no wiggle room if you lose your jobs, you have unexpected costs on your house like roof repairs, or interest rates go up. For example, a couple takes out a 15-year mortgage which feels very comfortable and they're very happy with the repayment schedule. But unfortunately, a recession hits and they both lose their jobs and they can no longer afford to pay their mortgage or their household bills. And this is why I say across all my videos that it's very important to build up an emergency fund. You want to start with at least 1 month, ideally get to 3 to 6 months. So if any of these unexpected bills come, or you lose your jobs, you can afford to pay all your bills in your house, including your mortgage, every month. So my tip is always pick the longest term possible that you can get. You can always overpay your mortgage if you choose to, although some companies do cap this at 10% of your outstanding mortgage balance. But overall, this is still going to be less than what you would pay if you took a shorter term in the first place. Mistake number two, overpaying without considering alternatives. It may seem smart to overpay, but it's not always the right answer. For example, if you did overpay £200 per month for 10, 15 years, yes, you would save interest, but you would also lose out on investing that money instead. So please see my video on should I overpay my mortgage, which in that video actually showed that you had a massive increase in wealth if you invested it rather than overpaid your mortgage. But that video will help you decide which one is best for your circumstances. So when deciding, consider your goals between balancing, reducing debt, and investing for the future. Mistake number three, ignoring interest rate types. So there's two types of interest rates, fixed and variable. So fixed is good because it gives you a very certain amount that you pay every month until the end of the promotion period. But if you take a fixed mortgage, if interest rates drop, then you miss out on the benefit of having a lower mortgage payment. This is where variable rates come in, that you can take a benefit of lower interest rates, but then if interest rates go up, so will your mortgage rate. So when you're deciding, it's very important to just decide on your risk profile of whether you'd want to have a certain amount to go out each month, or whether you want to take advantage of lower interest rates if they become available. Mistake number four, not accounting for all other costs. When you take out a mortgage on a property, it isn't just the mortgage you've got to pay. You've got to pay property rates, house insurance, any repairs that come up, whether you're changing your windows or fixing the plumbing or your gas boiler needs changing. So all these expenses can come out of nowhere. So it's very important you budget this to make sure you can pay all your mortgage back. So please see my video on the 50-30-20 rule, which talks through all of these different scenarios and different costs that you need to take account of. And please download my free budget planner in the comments. So mistake number five is not reviewing your mortgage regularly. So everybody will generally take out a promotional rate when they take out their mortgage, but not everybody then does a new promotional rate when they get to the end of their term. So it's very important you keep track of when your term ends, what your current interest rates are, and then you remortgage at the end of your promotional rate. Also, this can be very beneficial if you have a new life event. So for example, if you started having children or you're coming close to retirement, that everything can change. So even the type of interest rate you take out will also change. So always keep track of what you're doing and pay attention to it. Mistake number six, mortgage brokers. You don't need to use a mortgage broker to get the best rates in the market. For example, I have used First Direct for the last 18 years, and when I've compared mortgage rates, they've always been the cheapest, and I've always applied for it myself without having to pay a mortgage broker a fee to get me that mortgage. Mortgage brokers are there to make money. They're not there to guide you through everything you need to know. So for example, they won't provide you all these different mistakes and make sure everything you do is in your best interest. They are only there to make money. For example, a mortgage broker might try and tell you to pay a fixed upfront fee for your mortgage. But generally, this is very rarely worth it unless you've got a large mortgage balance to make it worthwhile over the promotional rate term. So please see my future detailed tracker where you'll be able to put in these different scenarios between fixed rate upfront fee, and compare how much you would repay and how much you would save over the length of your mortgage term for the promotional period. So my tip is you can still use mortgage brokers to get them to give you some rates, but still compare it to what you can find yourself and see what is best financially for your circumstances. So that brings us to the end of this video. Avoiding these mistakes will save you tens of thousands of pounds and a lot of stress over the length of the time you have a mortgage. If you like my free planner, please download it from the comments section, and please subscribe on the channel, which helps the channel grow. See you next time on Money and Life with Ross Jenkins.